Namaskar. Today we are here to discuss certain do's and don'ts for investors in today's markets. We start with our number of options for investments. For a normal investor, there are two types of investment products. That is financial products and non-financial products from which we can earn income in stock markets. In financial products, we have certain products like fixed income and market linked products. I further divide the fixed income products into 4 to 5 categories. For a normal investor, fixed income products can be categorized as saving bank accounts or post office bank accounts, then bank fixed maturity deposit accounts. Then there is another kind of account or investment that is called PPF, Public Provident Fund accounts. Then we have recurring deposit accounts in which we on monthly basis deposit a certain amount of money to get some kind of interest income. Then we have in financial product itself, we have market linked products for investors. In market linked products, we have got stocks that is divided into equity that we can invest through IPOs or FPOs. Then if we are not investing in the stock market through IPOs or FPOs, then we can invest in the same market through secondary market, which we call secondary market because we have not invested in IPOs, we are buying after the IPOs. Then in market link products also, we have got, apart from shares or equities, we have got mutual funds, which are categorized in 3 categories. That is number 1, equity mutual funds. Number 2 is debt mutual funds. And number 3 is mixed, that is debt and equity mixed mutual fund, which is called a balanced mutual funds. And similarly, in market-based products, we have got bonds and debentures also. Similarly, when we are going for investment of our money, we have got some non-financial investments which an investor can do. These are not through equities, they are not through mutual funds, but these are through some other things which is called bullion, gold or silver. An investor can always invest in bullion, that is in precious metals, or apart from precious metals also, real estate is also a good example of investment in which we can reap benefits over a long period of time by investing in real estates, properties, plots, farms, flats, etc. Now I'll take you through the snapshot of this presentation. The investments can be divided into investments in IPOs, FPOs, right issues, investments in secondary market. These are the takeaways of today's presentation. Investment in mutual funds, in public deposits, in buyback of securities, collective investment schemes, and dealing with a mediator or advisor or called stockbroker or sub-broker. When we deal with investment in IPOs, this is the first way of investing in stock market. That is how an initial investor starts investing his funds in equity market. There are certain do's for investing in IPOs, FPOs or right issues. When I am an equity investor, I have to look into certain important do's which I should do and certain important don'ts which I should not do while I am investing in stock market or primary market. I'll take you to the certain do's in the primary market itself. Number 1 do is read the draft red herring prospectus and pay special attention to risk factors, financials of the issuer, objects of the issue, background of the promoters, company history, outstanding litigations and defaults if any. IPO can be very lucrative from the perspective of a investor. But before I venture into investing any of my hard-earned money in IPOs or FPOs or right issues, first I have to look into the document of the company, that is the documents published by it through the SEBI and through on its websites and available in the market. That includes, this is RHPs, that is red herring prospectus, and all the documents which are on the record and also off the record. I have to make a special mention that an investor has to make certain kind of due diligence also before venturing into stock market. Another very important do is to use the ASPA process for applying IPOs and FPOs in a right issue or FPO. In case the investor is not successful in getting certain shares allotted to him and there is a refund, or there is a non-credit of shares in the demat account, in that case non-credit of shares to demat account or no refund of application money, in that case the share investor should not panic. He should not think that he has lost his money or his money is stuck somewhere. He should rather lodge a complaint to the company or its compliance officer or the RTA and also confirm the same from its bank whether it has got the refund of the money that he has invested or not. Another important do for an investor in IPOs is apply only one lot in retail category of IPO with a single PAN card. Multiplicity or duplicity should be always avoided. Apart from the do's in stock market, there are certain important don'ts also, which is stock investor should never do while investing in IPOs. For example, one of the don'ts is don't invest based on prevailing bull run for the market index or the scripts of other companies in the same industry or script of the issuer group companies. This means that one should never invest on the basis of bull run of a stock market or scripts. For example, a script of some company is already listed and then there is a requirement, there is another IPO from another same group company, same group but for another company. Then the performance of this new company or second IPO should not be judged on the basis of the another company in the same group. Another don't is that the scripts of the same similar industry should not be compared at par. One company in the same industry could be doing very well and this company might have not done well in the past, so the record of the another company should also be seen. Another don'ts in the IPO market is do not follow rumors or illusionary advertisements. Sometimes it so happens that before IPO there are certain news of the market, unpublished, unconfirmed news which are rumors, and one investor should never follow those rumors and he should do his own due diligence to invest in stock market. Then there is another thing, don't go by any implicit or explicit promise made by the issuer. Though these promises are otherwise legally banned, but in case there are some unofficial offers or some kind of lurements from the issuer of these securities, then these implicit and explicit promises should also be ignored. Another thing that happens in case of IPOs is that there are certain prices prevailing in the grey market, that in case some investor is successful in getting certain shares, that those prices, those shares or those securities can be traded in the grey market even before they get listed. So this kind is also to be, this don't is also to be considered, that do not bank upon the prices of your securities to be allotted in the grey market, and this should always be avoided. Apart from investing in the primary market, if we have missed the bus, we can still see that there is a secondary market. An investor must not lose his heart that he has lost the opportunity to invest in the stock market. Even if the IPO's window is closed, still post allotment and post listing, the shares can be still purchased through secondary market through the stock exchange, that is BSE or NSE. So while we are investing our money in the secondary stock market, we have to see that there are again certain do's for secondary markets also. Once I have decided or I have skipped the IPOs or the primary market, now I am taking the route to invest through secondary market. In secondary market, the first important thing is to deal, that is the do's, is to transact and deal only through SEBI registered intermediaries. That is the stockbroker that I am choosing, the depository that I am choosing, and the research analyst should be SEBI registered and not otherwise. I should not choose any other stockbroker or depository that is not registered with SEBI. Another do's that while I should consider while investing in secondary market is check the credentials of the company. The credentials of the company is very important to be seen. Before investing, I have to see whether my company is good company, whether it is paying dividend or not, whether it is a compliant company, whether the due diligence is always done or not. I should also inquire about the management of the company, whether the management is sound management or not, whether the company is, whether all the directors are qualified or disqualified, is there any kind of litigation in the company. The fundamentals of the company should also be seen. Another important thing that is to be seen, that I have to also check that how many complaints or investor complaints are pending, or how many investor complaints are registered against the company, or how many unsatisfied investors are available in the company. The more the number of unsatisfied investors are in the company, or the more the number of the complaints against the company, I can have an inclination or an idea that the company is into some kind of non-compliances. Before investing, apart from this, I have to see the financial position of a company also, which can be clarified from the returns available on the website, on the SEBI, and as well as ROC also. The recent announcements or the disclosures made by the company to the stock exchange should also be seen and considered before investing in secondary market. Another important aspect of investing in secondary market is to assess the risk return profile of the investment, as well as the liquidity and safety aspects. Before I invest, I must be clear, or I must be aware about the risk that is involved in my investment, and I should be also aware of the safety aspect of the hard earned money of the investor, that is myself. When I am investing, I should always consider that the money that I am investing remains safe. The capital should always remain safe. Prices can go down in secondary market, prices can go up, but it should not be the case that all the money that I am investing becomes zero. While I invest in secondary market, there is another important thing that has to be considered, is to scrutinize minutely both the transaction and the holding statements that I receive from my demat participant. It is important because it can be possible that I bought 500 shares and accidentally I punched 50 shares. So at the end of the day, when the settlement is done, I get only 5 shares or 50 shares or lesser amount of the share that I had purchased. It could be otherwise also. For example, I tried to purchase 50 shares and erroneously I punched 500 value. So the amount that is being debited from my account is obviously 10 times higher than what I intended to buy, and which was not my intention. And I keep quiet, remain silent, assuming that I had purchased 50 shares, and after 1 month, 2 months, 3 months, I realized that actually I had not purchased 50. Might be I purchased 5, or might be I purchased 500. So the accounting, my own accounting should be in perfect shape. My depository account statement should always be in reconciliation with my bank statement. Whatever my intention was has the instruction that I myself had done on my laptop or my computer. So if I bought 500 shares, it should also be reflected in my depository account. And if there is a technical glitch or something like that I notice, it should be immediately brought to the authorities that there is a system glitch and I have not received actual number of shares. Another which is very important for those investors who do margin trading, is that pay the required margins in the prescribed time. What happens if margin money is not paid after the expiry of the margin period? The shares are auctioned or the investment is auctioned, and what if the auction amount is lower than what my investment is? So actually what I am doing is I am trading something, buying some shares or equities on margin with the assumption that in future I will be earning some income. But what actually happens when margin is not paid, apart from penalty, the shares might have been auctioned or sold at a lesser price, and instead of earning some money, I end up incurring heavy losses. Another aspect of dealing in secondary market, which I was trying to discuss, is that what are the prohibitions, what are the don'ts, which things I should not do while dealing in secondary market. Number one don'ts is not to work on tips. I should not buy any shares. I should not do secondary market investment basis the tips. Another don't is don't deal with unregistered intermediaries. It is very important to know because unregistered intermediaries are nowhere to be seen once some bad transaction happens. Don't buy fundamentally unsound companies. This means that a share might be might is being traded at a very small amount, say 1 rupee, 2 rupee, 3 rupees, and I get a tip that within 1 month, within 15 days, it would be touching a price of 100 rupees. So this is not a fundamentally sound company. It is only a kind of penny stock which is being mechanized by some mover of the shares. So these shares should never be bought. Penny stock should not be bought, and actual research should always be done, and penny stock is always avoided. And it should be, don't buy fundamentally unsound companies, that is penny stocks, based on trading volumes or low prices or favorable news in the media. This media, what media refers, is unconfirmed media news. So penny stocks always start moving in larger volumes by unconfirmed and verified price statements, and these kind of investments should never be done by any sensible secondary market investor. Another don't is don't blindly follow investment advice given on TV channels, websites, and SMS. There are few TV channels that do research work and discuss stock market very diligently, but there could be certain websites luring the innocent investors to invest their funds in certain shares which will ultimately go into losses. There could be certain tips by way of WhatsApp messages, by way of SMS. All these tips are unsolicited, but what happens? Innocent investors invest their hard-earned money, assuming that they will invest their amount in these shares, and ultimately those share prices fall and they end up in big losses. Another important tip is for every kind of investment, don't fall prey to promises of unrealistic returns or guaranteed returns. In stock market, particularly in the secondary market, there is no guaranteed return. There is no unrealistic return. Shares of any company moves in a very systematic manner, and there cannot be any abrupt amount of increased heavy returns on some shares immediately. So do not fall prey to any promises of unrealistic return or any guaranteed returns. Secondary market does not provide any guaranteed return. That kind of return comes in investments with fixed amount of returns. Another don'ts that I can discuss is don't undertake off-market transactions in securities. Off-market transactions should never be done by first-time investors or unexperienced investors. Then I come to the investments in secondary market, certain other do's. Secondary market is always volatile and is always risky. One has to understand the risk associated with investing in securities before undertaking any transactions. I have to be very careful when I am investing any of my hard-earned amount in secondary market. I have to understand the risks which are associated with investing in securities market. This could be a natural risk, this could be a policy risk, this could be a war-like situation, when I have to consider that whatever I am investing is a risky proposition, and I have to understand that risk before venturing into this market. If I cannot have that kind of risk appetite, then I should not enter into secondary market. Rather, I should stick to fixed income investments like PPF, FD, saving bank account, or bullion like gold or silver. Another do is invest on sound reasoning and fundamentals. Sound reasoning and fundamentals is always important in secondary market. Because unless I invest on the basis of a sound reasoning, or if the fundamentals of a company are poor or are not understandable to me, I should immediately either move out of the company if I am already invested, or I should not venture into that company if the fundamentals of the investee company or the investee entity is not sound enough. There could be possibility that one of the friends of an investor says ki you buy a stock in my account or you buy investments in my account. It should also not be done. I should always insist on a contract note that comes from a demat participant for each transaction that I do, either purchase or sell, and I should personally verify all the details in the contract note, because contract note always tells me what I have done. I have debited certain shares, I have credited certain shares. What is the position of the transaction at the end of the day is reflected in the contract note. I should save the contract note for my future purpose, for my auditing purpose, for my accounting purpose. And on contract note only tells me on what date I have done that kind of transaction. So without contract note, if I instructed my stockbroker to do some transaction and he has not done it, that would be reflected in contract note. I can confront the stockbroker or my intermediary or my dealer or my broker that you have confirmed this transaction has been made, but my contract note is silent about it. So it could be possible that the broker or the mediator might not have executed your instructions of buying some shares or selling some shares, but you are under assumption that it has been done. No, it is not the case. It can only be confirmed when the contract note authenticates that this transaction has been done on your instructions. Another very, very important do's is we sometimes feel that whatever SMS or whatever WhatsApp is coming to our phone is irritating us. More particularly when we are a stock market investor, we should always be alert and we should always mandate that our trade alert should always be there. So in nutshell, it can be said registered for trade alerts on SMS and email. So whatever trade I do, I sell some shares, I buy some shares. At the end of the day, after transaction hours, I must get a trade alert that I have purchased these numbers of securities, I have sold these number of securities, followed by an alert that should be activated and that should be mandated. And I must receive it on my email ID that I very frequently use. So the confirmation should be two-sided. On my SMS also, or my WhatsApp also, and on my email, the summary of the transaction in the shape of contract note should always be there, and alert should always be activated. Another aspect is to check the brokerage and the other fees are levied in the transaction are also there and are reasonable. There is another option of investors who invest for a long period of time. They are not day traders, they are not short-term traders, but they simply buy certain investments and forget it or keep it for long-term purposes, say 1 year, more than 1 year. So if I had bought Reliance share, say around 5 years back, I would have earned huge money, but I am not a trader, I am not a short-term trader. I have invested it for some purpose. My objective of trading was to keep it for long term. So in that case, I should rather use the facility of freezing my demat account, so that erroneously or by some malafide intention, some person who holds hand on my demat account does not transfer it to his account or does not sell off my shares, which is very rare. But in that case, if my option or my objective of investment is a long term, in that case, I should rather freeze my demat account. There are certain other don'ts also. Do not forget to take account of potential risks that are involved in the investment. I may repeat, I should not forget to take account of the potential risks, because every investment comes with certain cons also. There are certain risks associated with every kind of industry, let it be chemical industry, IT industry, pharma industry. Every industry comes with a risk, and I should always consider the potential risks that are involved in the investments. No investment is free of risk free. There is another important don't, which is actually a do's in the shape of don'ts. Do not hesitate to approach the proper authorities for redressal of your doubts or grievances. Sometimes what happens, a shareholder might hesitate that this is happening, this is not happening to me only, this might be happening to lakhs of investors. So I should sit silent and I should not approach any authority, or I should not be very concerned about it, because ultimately said today or tomorrow this grievance, this complaint would be redressed, so somebody will take care of. But it is not the case. It could be case where I am the only isolated person. So do not hesitate to approach the proper authorities for redressal of your doubts and grievances. I may quote an example. Could be an example where one of your relatives, say your grandfather or your grandmother or father, purchase certain shares and you are not aware of it. And the share value is today very much. But you do not know. And fortunately or unfortunately, you get to know from somebody or some relative or some document or some going through the old papers or files that certain shares were invested by your such and such relative. So you are in a doubt that whether those investments still are in force or not. So do not doubt. Take the help of some consultant, take the help of some chartered accountant, company secretary or advocate, or even don't hesitate to approach the concerned company secretary, RTA, compliance officer of that company to know that whether such shares existed or not, and whether such shares exist in the name of your so and so relatives or not. So do not ever hesitate to approach the proper authorities for redressal of your doubts or grievances. There could be a possibility that certain company changes its name, and in your demat account you knew that you have invested your amount in the name of XYZ company, and today the name of XYZ company is not available, and fortunately the shares are also there, but the name of the company is different. So you are not aware, you might not have received the documents while the company sent to you during the process of change of name. So do not hesitate to write to the company and ask whether you have changed your name. In case it is like that, then please inform us. Do not share your trading username and password to others. This is very important, and more particularly when you are doing such kind of trading on a public platform or some cafe or some borrowed laptop or some borrowed mobile phone. Do not save the auto save options. Do not share your trading username and password to others, except that when you are very much confident and you are sitting with that person who is carrying out your instructions at your behest only. If you are doing it on your own, well and good. If you are getting it done through somebody else with the help of somebody else, just remove the user ID and password and do not save those on your laptop or your system, because you never know when that credentials can be misutilized and your shares could be sold, or any number of loss making securities could be bought on your behalf. Another don't that is very important is, don't invest on the basis of rumors and tips. The other day I took a seminar somewhere and I was asking the audience that is there any person who has a positive portfolio, and out of a gathering of hundreds only one person said I have a positive profit making portfolio. So I asked the remaining audience that what made them a negative portfolio, and majority of them told me that they had invested in the stock market basing on some tips, some advisory, some rumors or some information roaming around in unofficial channel that this share will go up, this share will go down. So we bought those shares at a time or at a price when it was not to be bought. So the important thing is you have to do your own diligence and do not invest on the basis of rumors and tips. Tips are always dangerous in stock market. Do not follow the herd or play on momentum. This is a common thing which happens, that everybody is buying X number of securities at X number of price and they will sell it at X